Boeing has filed its 10Q for the first 6 months of fiscal 2026, and it contains two numbers pointing in opposite directions. Revenue grew almost 11%, and operating cash flow swung by more than $2.5 billion into positive territory. At the same time gross margin fell, free cash flow was still negative, and the company still reported a net loss. So which one is the real signal? Over the next few minutes, we'll go line by line through the income statement, the three operating segments, the margin bridge, the cash flow statement, and the balance sheet, and work out what is actually healing at Boeing and what is not. Boeing designs and builds commercial jets. It builds defense and space systems for governments, and it sells parts, maintenance, and training to the operators of both. Those are its three reporting segments, and we'll take each of them in turn. One framing point first, because it changes how you read every number in this video. This is a 10Q covering the first 6 months of fiscal 2026, ended the 30th of June. Every revenue, profit, and cash flow figure is cumulative for those 6 months, and it is compared with the same 6 months a year earlier. The balance sheet works differently. It is measured against the end of the prior fiscal year. So those movements are changes since the start of the fiscal year, not year over year. Revenue for the 6 months came in at $46.8 billion, up 10.7% on the same period last year. Operating income more than doubled to $604 million from $285 million. But the bottom line is still red. Boeing reported a net loss of $448 million, narrower than the $648 million loss a year earlier, and diluted loss per share of 79 cents against $1.09. And the figure that gets the least attention is arguably the most important one. Operating cash flow was positive at $1.19 billion, against negative $1.39 billion a year ago. That combination, a doubling of operating income alongside a continuing net loss, is where most of the story sits, so let's be precise about what each number is worth. The operating income figure looks spectacular in percentage terms, only because the prior year base was almost nothing. $285 million on $42.2 billion of revenue, a margin of 0.7%. The absolute step-up is $319 million on a $47 billion revenue line. Real, but small. The cash flow swing is the opposite. $2.5 billion of movement in operating cash flow is a large absolute change on any base, and it happened while the income statement was still loss-making. Cash, not accounting profit, is the genuine inflection here. All three segments grew, which matters, because it means the recovery is not resting on one franchise. Commercial airplanes is the largest, at $20.95 billion of revenue, up 10.2%, and just under 45% of the total. Defense, space, and security came in at $15.08 billion, up 16.8%, and now accounts for 32% of revenue. Global services contributed $10.71 billion, up 3.6%, and just under 23% of the total. Nothing in the segment table is shrinking, either in dollar terms or in growth rate. Rank them by contribution and the picture sharpens. Defense, space, and security added roughly $2.2 billion of revenue year over year, the largest dollar increase of the three and the fastest growth rate at nearly 17%. Commercial airplanes added about $1.9 billion, growing in double digits. Global services added roughly $370 million, the slowest of the three at 3.6%. So the mix is tilting toward defense and commercial production, and away from the aftermarket services business. Segment profitability isn't broken out in the data we have, so we can't quantify the effect. But a mix shift toward volume-heavy production is one plausible piece of the gross margin story we're about to look at. This filing gives us two comparable 6-month periods, so the trend line is short, but the direction on each line is unambiguous. Revenue went from $42.2 billion to $46.8 billion. Gross margin went the other way, from 11.5% to 10.6%. Operating margin improved from 0.7% to 1.3%. Net margin improved from negative 1.5% to negative 1.0%. The loss per share narrowed from $1.09 to 79 cents. Operating cash flow went from minus 1.4 billion to plus 1.2 billion, and free cash flow from minus 2.5 billion to minus 823 million. Everything is improving except gross margin. Hold that thought. Here's the bridge, from the top of the income statement down. Revenue grew 10.7%. Cost of revenue grew faster, 11.8%, to $41.8 billion. That gap is why gross profit rose only 2.2% to $4.96 billion, and why gross margin fell 0.9 of a percentage point to 10.6%. In plain terms, the extra volume is arriving at a thinner marginal margin than the existing business. Below gross profit, the story reverses. Research and development rose just 4% to $1.82 billion, well behind sales growth. That expense discipline is what lifted operating income to $604 million and operating margin from 0.7 to 1.3%. The margin improvement is a cost control result, not a unit economics result. Then it gets unusual. Operating income was positive $604 million, but pre-tax income was negative $339 million. That is roughly $940 million of non-operating and financing cost sitting between the two lines, consistent with a company carrying $45.6 billion of long-term debt. And on that pre-tax loss, Boeing still booked a tax charge of $96 million, which pushed the net loss below the pre-tax loss. A tax expense on a loss usually points to unrecognized deferred tax positions or non-deductible items rather than anything flattering. One more per-share drag. The diluted share count rose to 789 million from 755 million, 4.5% more shares, which muted the improvement in loss per share. Now, the cash statement in detail. Operating cash flow was positive $1.19 billion against negative $1.39 billion a year ago, a swing of about $2.57 billion. Depreciation and amortization of $1.17 billion, up from $926 million, is part of the bridge between the accounting loss and the cash. But capital expenditure nearly doubled to $2.01 billion from $1.1 billion. Subtract that, and free cash flow is still negative at minus $823 million, a big improvement on minus $2.49 billion, but not yet self-funding. On capital returns, the statement shows $172 million of dividends paid, up from $158 million and no share repurchase. The balance sheet is where the caution lives. And remember, these comparisons are against the end of the prior fiscal year. Equity stands at $6.1 billion, up from $5.45 billion at the start of the fiscal year, but retained earnings actually fell to $16.6 billion from $17.3. So the equity increase did not come from earnings. Against that, total liabilities are $159.8 billion, which puts debt to equity at 26.2 times, with a current ratio of 1.14. The genuine positive is deleveraging. Long-term debt cut by about $8.3 billion to $45.6 billion. The catch is how it was paid for. Cash fell to $7.2 billion from $10.9, and short-term investments to $12.8 billion from $18.5. Roughly $9.4 billion of liquidity was consumed to fund $8.5 billion of financing outflows. That is leverage relief bought with the buffer, not with generated cash. Two things are notably absent from this report, and absence is information too. First, insider activity. 0 open market purchases and 0 open market sales by directors, officers, or 10% holders in the window covered by the data, and no grants or tax withholding disposals to net against them either. That is not evidence of conviction, nor of caution. It simply means there is no insider signal here to read. Second, the only recent corporate event on file is the 28th of July 8K, which furnishes the quarterly press release and contains no financial figures of its own. No guidance, no earnings call data, no acquisitions, no capital raise, no buyback announcement. The informational weight rests entirely on the filing itself. So what should you be tracking in the next filing? 4 things. 1. Gross margin. The entire operating margin improvement came from below gross profit. So if cost of revenue keeps outrunning revenue, the recovery stalls where it matters most. 2. Free cash flow. With capital expenditure running at $2 billion for 6 months, operating cash flow has to keep climbing for free cash flow to cross zero. 3. The liquidity stack. After roughly $9.4 billion of cash and short-term investments were drawn down, watch whether that balance stabilizes or keeps funding debt retirement. And 4. The path to positive net income. A $339 million pre-tax loss, plus a positive tax charge, means break-even needs considerably more than the current operating run rate. The one-line version: Boeing's operations are healing faster than its income statement, but the repair is being paid for out of the liquidity buffer rather than out of earnings. Volume growth is broad and real, cash flow has genuinely turned, and $8.3 billion of long-term debt is gone. Gross margin, free cash flow, and the equity base have not turned yet. Momentum is visible, resilience is not. That is the report. All figures come from the 10Q. This is educational analysis, not investment advice.